The Bank of Canada has hiked its key overnight interest rate again, this time by 50 basis points, and that brings the rate to 1.5%. The central bank bumped the rate by a quarter point in March and then by a half point in April, the biggest increase in 22 years. The rising rate is aimed at cooling inflation, which hit 6.8% back in April. To discuss what this means for you, for your finances, your mortgage, we welcome back to CP24 tonight Bryan Borzykowski, business journalist and founder of All Caps Content, and Erica Alini, personal finance reporter at the Globe and Mail. Welcome to both of you. Thanks so much for joining us. Bryan, this was widely expected, and it has everything to do with inflation, doesn't it?
Yeah, that's right. It was widely expected, so it wasn't a surprise, although it's still very interesting just because we haven't seen 2.5% rate hikes in, ever in Canada, or at least not a very long time. I think it's the first time this has happened. So even though it's been expected, it's still a lot of people are talking about it. And yes, it's because of inflation. We're seeing prices rise year over year in all sorts of different categories. And the idea is to make it harder to borrow, which then makes it harder to kind of put money into the economy, which slows the economy down. It seems a bit counterintuitive. We always talk about we want, high growth in the economy, but you don't want it too high, or demand for goods goes up. People start buying all the sorts of things, and then prices rise, and then it gets too difficult to buy, and that could crash the economy. And so they want to kind of slow it down so that we don't go to a big recession, although raising rates too high too quickly could do that.
Right. Okay, that's interesting. Joining this discussion is Simeon Papailias with Royal LePage Signature Realty. Welcome to you. Let's start by asking you what you think this rate hike means for people's mortgages and the country's housing market.
Yeah, I think, there's still a tremendous amount of shock out there. We're very fortunate to represent a significant share of the investment focused marketplace in the Greater Toronto area. So we've had a lot of feedback from hundreds, at this point, maybe thousands of clients over the last 90 days, where they're looking for some direction as to where are we going, what does this mean for my prices, and I just like to remind everyone that for all the things that sometimes we poke fun at the government that they do wrong, we do in Canada have a very, very well thought out system where back in 2018, January 2018, they introduced the qualification to be done at a much higher level than what the rates were at the time, because there were historic lows then, and we've seen historic lows since. So every single person who has a mortgage has been qualified at rates quite a bit higher than where we sit today.
Right.
So everybody should be in a decent position, but things are about to get a bit tighter for sure.
Okay. Erica, on that note, do you think people understand what that means for their finances when the bank continues to raise rates back to back like this? Is that financial literacy there, do you think?
Yes and no. So there's people definitely understand. I think most people have a grasp of what it means for their mortgage payments. If you have a variable mortgage rate, your rate may go up, although a lot of Canadians have fixed payments, even for variable mortgage rates. But that's quite well known. I think the part that may catch people off guard is lines of credit. And that's a really important one. Lines of credit generally have variable interest rates, and those payments do tend to go up and down with the general level of interest rates in the economy. So with rate hikes or rate cuts from the Bank of Canada, your line of credit payments tend to change.
Right. So, Simeon, that is where you come in. If you have a line of credit or a variable rate mortgage, how much is this going to hurt you?
Well, it's not the... It's been the fastest growth in interest rate, obviously, in Canadian history, but it's still, we're going from zero, from like almost free money
right,
to what's still a historic low. So I think we really have to be cognizant of the fact that we're very blessed to be in this range, but we do have to prepare. And if you are if you're in a situation where you have controlled income and the rate really is going to impact your household, I would say this is the time to speak to your mortgage professional and get some advice as to converting that variable product into something fixed and or restructuring the debt on terms that are more cohesive to your individual situation. I hate to speak in generalities, but if you are in a variable line of credit and you have significant money on it, as per our peers' advice, this is the time to start looking seriously into that.
Yeah, it doesn't hurt to talk to your financial advisor, right? Bryan, I think the average person might be thinking, well, if I'm having trouble paying my bills, why would the central bank do this? Can you help us understand how that works?
Right. I mean, that is actually a valid question in that, and sort of why didn't they do this a few years ago? Because it seems like they're kind of making up for lost time since 2008. Now prices of housing have gone up crazy amounts over the last several years. And so these kinds of hikes, which have not really, we haven't really seen this in a long time. We were at 1.75% before the pandemic, which is still pretty low. And the Bank of Canada said they're going to keep increasing rates from here. People might be wondering why now? And I think really they're looking at, the growth in housing, trying to cool that down a bit. And I think right now the unemployment rate is very low. So people are working. They're hoping people can afford these increases. If you can't afford it, yes, it's going to be difficult. But inflation is rising in part because of global forces. So whatever the Bank of Canada does, and that's, I think, a big question, is how will this actually tamper inflation down, in that a lot of food prices are probably going to continue to rise. Gas prices could continue to rise. So really, if someone can't afford it, they're really going to have to look at their budget. It may not affect them as much. Do they have lines of credit debt? They probably have credit card debt, which won't go up. That's already high. But it's really looking at that budget and seeing what you can afford.
Yeah, and speaking of that budget, Erica, food prices, gas prices, there's so much to consider here, right? The cost of living at its highest in 30 years. Simeon said it might be time to speak to your financial advisor at the bank. Is it time for families to maybe start changing their financial habits or take a good look at that budget, as Bryan noted?
Yes, I would say so. And it's hard because we've been cooped up at home for 2 years, and now it's the summer, and we all want to celebrate and go out and travel. But at the same time, we have inflation, we have interest rates going up. So if you have debt, you could be squeezed on two sides. And also, as Bryan was saying, if there is a risk that this very quick interest rates hikes that will end up in a recession. And so that's something else to keep in mind. And, do you want to accelerate your debt payment to free up some budget? Do you want to build up, cash for an emergency fund? Those are definitely things to keep in mind right now.
Okay, that is interesting because, Bryan, you talked about this as well. These back-to-back rate hikes could trigger a recession. How likely is that to happen?
It's hard to say. It's hard to predict what will happen in the future. I think they're trying to do, it seems like it's very fast, but I think they're trying to cool the economy down so people kind of don't overreact, start spending too much, and then kind of a trigger recession that way. I think it's possible. There's a lot going on in the world. Supply chain issues are still happening. We're seeing the markets decline. There's still a lot of things going on where there are a lot of people who are predicting kind of a recession is going to come, which, we had a recession in the pandemic. We recovered quickly. It doesn't mean it's 2008 again. But really, I think we just have to kind of be careful. I think this is going to the rate hike probably will hurt businesses more. Businesses that have taken money, that are investing in their own operations, are going to hold back. That could actually cause job losses. So I think that's something to watch. But I don't know what it's going to be like, but certainly the economy is going to soften. That's what the Bank of Canada wants to do.
And we know more hikes are on the way, so there's a good chance we'll be chatting with all of you sometime soon. Bryan, Erica, and Simeon, thanks so much for your time and for this discussion tonight.
Thank you.
My pleasure.
Thank you.